Every car insurance coverage explained and the hidden costs they don't tell you about. Liability coverage. Think of liability insurance as your legal entry ticket to the road, but also your financial shield when you're the one who messes up. This one's non-negotiable in most states. If you want to legally drive your car, you're going to need it, and for good reason. Liability coverage is what helps pay for the damage you cause when you're at fault in an accident, but it's split into two parts, and here's how that works. Bodily injury liability. First, there's bodily injury liability. This covers medical expenses, lost wages, and other costs if you hurt someone in an accident. It doesn't just cover you, the driver, but also your family members if they're driving your car or even someone else's car with permission. Accidents can get expensive fast, especially if someone gets seriously injured. That's why experts always say don't just settle for the state minimum coverage. A single ER visit can wipe out $25,000. Imagine if you hit someone in a luxury car or a packed SUV. If you've got a house, savings, or anything else worth protecting, it's better to have more coverage than to wish you did after an accident. But here's what insurance companies don't tell you about bodily injury liability coverage levels. Most companies offer it in what's called split limits, like 25/50/25, which means $25,000 per person, $50,000 per accident for bodily injury, and $25,000 for property damage. But they also offer combined single limits, like $100,000 total per accident. Here's the kicker. Combined single limits often cost less than split limits for the same total coverage because the insurance company has more flexibility in how they pay claims. The minimum coverage in some states is as low as $15,000 per person. That might sound like a lot until you realize that the average cost of a serious car accident injury is over $57,000. If you cause an accident that seriously injures someone and your coverage maxes out at $15,000, guess who's responsible for the remaining $42,000? That's right, you personally. They can come after your house, your savings, even garnish your wages for years. Property damage liability coverage. But what happens when you accidentally hit something that isn't another car? Well, that's where property damage liability coverage comes in. If you or someone you allow to drive your car accidentally smash into another vehicle, a fence, a building, or even a streetlight, this coverage helps pay for the repair or replacement costs. It's easy to forget how expensive things like that can be until you actually knock one over. Here's a real-world example that'll shock you. A driver in California accidentally crashed into a Tesla Model S Plaid. The repair bill? $73,000. His property damage coverage? The state minimum of $5,000. He's now paying $68,000 out of pocket, plus legal fees. And while some states only require as little as $10,000 in coverage, trust me, that won't go far if you crash into a luxury car or a storefront. Most insurance companies offer property damage coverage from $10,000 all the way up to $500,000 or more. That's why it's smart to go for more coverage than the bare minimum. A little extra can save you from a massive bill later on. Medical payments coverage and personal injury protection. Now let's talk about what happens if you or your passengers get hurt. This is where medical payments coverage, or MedPay, and personal injury protection, or PIP, come into play. Think of MedPay as a basic safety net. It helps cover medical bills from an accident, no matter who was at fault. So if you're hit by someone else, or even if the accident was your fault, MedPay can help with doctor visits, hospital stays, and things like x-rays or surgeries. Most insurance companies offer MedPay in amounts ranging from $1,000 to $10,000, with some going as high as $50,000. The coverage is relatively cheap, often just $20 to $40 per year for $5,000 in coverage. But here's what they don't tell you. MedPay pays in addition to your health insurance, so it can cover your deductibles and copays. PIP, on the other hand, is like MedPay's bigger, stronger cousin. It doesn't just cover medical expenses, it can also help with lost wages if you can't work after the crash, pay for services you can't do while recovering, like house cleaning, and even cover funeral costs in extreme cases. PIP takes care of the driver and passengers in your car, so it's a pretty solid choice if you want broader protection. But here's the insider secret about MedPay and PIP that most people never learn. In some states, PIP is mandatory, but the coverage amounts are often laughably low. Florida, for example, requires $10,000 in PIP coverage. Sounds decent until you realize that a single night in the hospital can easily cost $15,000 or more. The insurance companies love these low mandatory minimums because they get to sell you compliance while leaving you massively underprotected. In states where PIP is optional, insurance companies typically offer it in amounts from $2,500 to $50,000, with some companies going higher. The key difference is that PIP usually covers 80% of your lost wages up to the policy limit, while MedPay just covers medical bills, collision insurance, and comprehensive insurance. But let's dive into the part of car insurance that covers damage to your own vehicle. This is where physical damage coverage comes into play. It's made up of two key types: collision insurance and comprehensive insurance. Both are super useful if you want peace of mind, especially if your car is newer or has some serious value. Let's start with collision insurance. Imagine you get into a fender bender, hit a tree, run into a pole, or even flip your car. Collision coverage steps in to help pay for the repairs. It even covers damage from nasty potholes, which, depending on how bad the hit is, can cost you hundreds or even thousands to fix. But here's the catch. Collision coverage usually comes with a deductible. That's the amount you'll need to pay out of pocket before your insurance picks up the rest. Most insurance companies offer collision deductibles ranging from $100 to $2,500. Here's the math that matters. Choosing a $1,000 deductible instead of $250 can save you $300 to $500 per year in premiums. But that also means you'll pay more upfront if you ever make a claim. The sweet spot for most people is a $500 deductible, enough that you won't be financially stressed if you need to use it, but high enough to keep your premiums reasonable. Now here's something most people don't know about collision coverage. Insurance companies use something called diminished value to determine payouts. Even after your car is perfectly repaired, it's worth less because it has an accident history. But standard collision coverage doesn't pay for this diminished value. So you could have a $50,000 car, get it perfectly repaired after an accident, but now it's only worth $42,000. That $8,000 loss, you eat it unless you have special diminished value coverage, which some insurance companies offer as an add-on. Now onto comprehensive insurance, which covers just about everything not related to a crash. So if your car gets damaged by a storm, vandalized, stolen, or hit by a deer on the highway, that's where comprehensive coverage steps in. Think of it as your all-around protection against the unpredictable stuff. Things like hailstorms, floods, fire, or even falling tree branches. Comprehensive coverage typically has the same deductible options as collision, but here's an insider tip. Some insurance companies offer zero deductible for glass replacement. This means if a rock chips your windshield, you pay nothing to get it fixed. Other companies offer separate glass deductibles, usually $50 to $100, which is much lower than your regular comprehensive deductible. But what's the main difference? A collision is for when you hit something. Comprehensive is for when something hits you or when unexpected events mess with your ride. A lot of car owners choose to have both, especially if their car is valuable or still under a loan or lease. Together, they give you a solid safety net, so you're not stuck with a huge bill when life throws something at your car, literally or figuratively. Here's a comprehensive coverage horror story that'll make you think twice about skipping it. A hailstorm in Texas caused $2.8 billion in damage in a single day. Cars that looked fine from a distance had thousands of tiny dents that cost $8,000 to $15,000 to repair properly. Drivers without comprehensive coverage had to choose between driving a dented car or paying massive repair bills out of pocket. But what if you're not the one at fault, and the other driver has no insurance, or disappears? Uninsured and underinsured motorist coverage. But what if you're not the one at fault, and the other driver has no insurance or disappears? Well, that's where uninsured and underinsured motorist coverage steps in, and trust me, it's more important than you might think. You see, uninsured motorist insurance coverage protects you when someone with zero insurance hits your car, or worse, in a hit and run where they just vanish. Believe it or not, there are still plenty of drivers on the road without any insurance. According to the Insurance Research Council, about 13% of drivers nationwide are uninsured. In some states like Florida and Mississippi, it's over 20%. If one of them hits you and you don't have this coverage, you could be stuck paying for everything out of your own pocket. But with uninsured motorist coverage, your own insurance company helps cover the medical bills and damage to your car. It even covers passengers riding with you at the time of the accident. Most insurance companies offer this coverage in the same amounts as your liability coverage. So if you have $100,000 in bodily injury liability, you can get $100,000 in uninsured motorist coverage. Then there's underinsured motorist insurance, which is sort of like the backup plan for the backup plan. Some drivers do have insurance, but just the bare minimum their state requires. And let's be real, if you're in a serious crash, those minimum limits won't go very far. That's where underinsured motorist coverage picks up the slack. It helps pay the difference between what their policy covers and what the actual repair or medical costs are. Here's how underinsured motorist coverage works in practice. Let's say you're seriously injured in an accident caused by someone with only $25,000 in coverage, but your medical bills are $75,000. If you have $100,000 in underinsured motorist coverage, your insurance will pay the $50,000 difference after the other driver's insurance pays their $25,000. Most people bundle these two together for full protection. It's a smart move, especially when you consider how many people out there are cutting corners with their insurance. After all, why should you have to suffer financially because someone else didn't bother to get proper coverage? The cost is usually very reasonable, often just $50 to $100 per year for substantial coverage. Rental reimbursement coverage. But here's one of those add-ons that people often skip until they find themselves stuck without a car. It's called rental reimbursement coverage, and while it's optional, it can really save the day when your car's in the shop after an accident. Let's say you've been in a crash and your car needs serious repairs. With rental reimbursement coverage, your insurance will help cover the cost of a rental car or even public transportation while yours is getting fixed. Imagine this. You're rear-ended and your car's in the shop for 12 days. Without rental reimbursement, that's 12 days of Uber bills stacking up fast. In a major city, that could easily cost you $500 to $800 just to get to work and back. You might also hear this called rental car coverage or transportation expense coverage, but it all means the same thing. It's there to keep you moving when your own wheels are out of commission. Most insurance companies offer rental reimbursement in daily amounts, ranging from $20 to $100 per day, with time limits from 30 days to several months. The most common options are $30 per day for 30 days or $40 per day for 30 days. Now this isn't a freebie. You'll need to pay a little extra to add it to your policy, but for many, it's worth the convenience. The cost is usually very reasonable, often just $20 to $40 per year for $30 a day coverage. It only kicks in if the damage to your car is covered by your policy, so if you have collision or comprehensive coverage and file a claim, that's when rental reimbursement can come into play. For example, if a hailstorm smashes up your car or someone rear-ends you and it needs bodywork, this coverage helps with your temporary transportation costs. Usually there's a set limit, like $30 a day for up to 30 days. If If you pick a fancy rental that costs more, you'll have to cover the difference. One nice thing, this coverage usually doesn't have a deductible, though your collision or comprehensive claim might. Emergency roadside assistance. But here's a real lifesaver on the road: emergency roadside assistance. If you've ever had your car break down in the middle of nowhere or locked your keys inside, you know how stressful that can be. It's 10 p.m. You're stuck on a dark highway with a flat tire. That's when emergency roadside assistance becomes your favorite insurance add-on. This coverage is like having a pit crew on call 24/7, ready to jump in when your car leaves you stranded. So, what does it cover? For starters, towing. If your car won't start or can't be driven, they'll tow it to the nearest repair shop. Most insurance companies include towing up to a certain distance, usually 15 to 100 miles, depending on your coverage level. You'll also get help with fuel delivery if you run out of gas, battery jumps if your car won't turn over, flat tire changes, and even locksmith services if you lose your keys or leave them in the car. Here's the cool part. Many insurance companies have direct billing deals with roadside service providers. That means if you call for help, they usually handle the bill for the service call itself. You don't have to pay up front for things like towing or unlocking your car. But keep in mind, if you need a new battery, a tire, or a full tank of gas, you'll likely have to pay for the item itself, because insurance typically only covers the delivery and service, not the product. Most insurance companies offer roadside assistance in different tiers. Basic coverage might include towing up to 15 miles and simple services like jump starts and lockouts. Premium coverage could include towing up to 100 miles, concierge services to help arrange repairs, and even trip interruption benefits if you break down far from home. The cost is usually very reasonable, typically $15 to $30 per year for basic coverage, or $30 to $50 for premium coverage. But here's what they don't tell you about roadside assistance. The response times can vary wildly depending on your location and the time of day. In rural areas or during peak times, you might wait 2 to 3 hours for help. Some companies offer priority service for an extra fee, but even that doesn't guarantee fast response times. Also, if you use roadside assistance frequently, more than 3 to 4 times per year, some insurance companies might raise your rates or even drop your coverage. Gap insurance. Now let's talk about something a lot of car buyers don't think about: gap insurance, or as it's officially called, loan or lease payoff coverage. If you're financing or leasing a car, especially a brand new one, this little add-on could save you from a major financial headache. The moment you drive a new car off the lot, it starts to lose value, but your loan or lease doesn't shrink nearly as fast. So let's say your car gets totaled in an accident or stolen and never recovered. Your regular insurance will only pay you the actual cash value of the car at that time, which is often less than what you still owe on it. And you know what? That's the dreaded gap, and it can be thousands of dollars. Gap insurance steps in to cover that difference, so you're not stuck making payments on a car you no longer have. This kind of coverage is especially important in the first few years of owning a car, when depreciation hits the hardest. It's also popular among people who lease vehicles or finance them with small down payments. The requirement? You typically need to have both collision and comprehensive coverage on your policy to qualify for gap insurance. Here's a real example that shows why gap insurance matters. A driver bought a new $35,000 SUV with a small down payment. 6 months later, it was totaled in an accident. The insurance company valued the car at $28,000, but he still owed $32,000 on the loan. Without gap insurance, he would have been stuck paying $4,000 for a car he no longer had. Plus, he'd need to finance a new car on top of that. Most insurance companies offer gap coverage for about $20 to $40 per year, which is much cheaper than buying it from a car dealer, where it often costs $500 to $700 up front. Some insurance companies automatically include gap coverage for the first year or two on new car policies, while others offer it as an optional add-on. When you need it is, but if you put less than 20% down, have a loan term longer than 4 years, or bought a car that depreciates quickly. Luxury cars, electric vehicles. When you don't is, if you put 25% plus down, have a short loan term, or bought a car that holds its value well. Toyota, Honda, certain trucks. If you pay off your loan early or your loan balance drops below the car's value, you can cancel gap insurance and get a prorated refund. New car replacement coverage. But gap insurance isn't the only protection for new car buyers. There's also new car replacement coverage, which goes even further. If your brand new car gets totaled within the first year or two, this coverage pays for a brand new replacement car of the same make and model, not just the depreciated value. It's like gap insurance on steroids, but it only applies to very new vehicles. Most insurance companies offer this coverage for cars that are less than 1 year old, and some extend it to cars up to 2 or 3 years old. The cost is usually $50 to $100 per year, and it could save you thousands if you total a new car. Some companies call it better car replacement, and will even upgrade you to the current model year if your exact car isn't available. Here's how it works. If you total your 6-month-old Honda Civic, instead of getting $22,000 for a car you paid $25,000 for, you get a brand new Honda Civic from the dealer. The insurance company pays the full retail price, not the depreciated value. Original equipment manufacturer, OEM, parts coverage. When your car gets damaged and needs parts, standard insurance policies allow the repair shop to use aftermarket or used parts to save money. But there's a coverage option that ensures only brand new, factory parts are used in repairs. Original equipment manufacturer coverage, or OEM coverage. This coverage keeps your car's value higher and ensures the repairs meet the manufacturer's standards. It's especially important for newer cars or luxury vehicles, where aftermarket parts might not fit as well or last as long as factory parts. Most insurance companies offer OEM parts coverage as an add-on for about $30 to $60 per year. Here's why it matters. Aftermarket parts might save the insurance company money, but they can affect your car's safety, performance, and resale value. OEM parts are made to the exact same specifications as the original parts, ensuring your car performs and looks exactly like it did before the accident. Some insurance companies automatically use OEM parts for cars under a certain age, usually 2 to 3 years old, while others require you to specifically request and pay for this coverage. Custom equipment coverage. If you've added aftermarket modifications to your car, like a custom stereo system, performance upgrades, or special wheels, standard insurance policies typically won't cover these items. That's where custom equipment coverage comes in. Most insurance companies offer custom equipment coverage in amounts ranging from $1,000 to $20,000 or more. This covers permanently installed equipment that wasn't part of the original vehicle, like upgraded sound systems, custom paint jobs, performance modifications, or specialized equipment for disabled drivers. The cost varies depending on the value of your modifications, but it's usually quite reasonable, often $50 to $150 per year for $5,000 in coverage. You'll typically need to provide receipts or appraisals for expensive modifications. Here's the catch. Most insurance companies require that modifications be professionally installed and that you declare them when you buy the policy. If you add modifications later and don't tell your insurance company, they might not be covered. Usage-based insurance programs. Now let's talk about one of the biggest innovations in car insurance. Usage-based insurance programs. These programs use technology to track how you drive and can significantly reduce your premiums if you're a safe driver. Most major insurance companies now offer some form of usage-based insurance. Progressive has Snapshot, State Farm has Drive Safe and Save, Geico has Drive Easy, and Allstate has DriveWise. These programs typically use a smartphone app or a device that plugs into your car's diagnostic port to monitor your driving habits. They track things like how fast you drive, how hard you brake, how quickly you accelerate, what time of day you drive, and how many miles you drive. Safe drivers can save 10 to 30% on their premiums, while risky drivers might see their rates increase. Pay-per-mile insurance is another option that's perfect for people who don't drive much. Companies like Metromile, now part of Lemonade, charge a low base rate plus a few cents per mile driven. If you only drive 5,000 miles per year instead of the average 12,000, you could save hundreds of dollars. Here's what they don't tell you about these programs. The data collection can be quite detailed. Some programs track your location, phone usage while driving, and even the specific roads you drive on. Make sure you understand what data is being collected and how it's used before signing up. Non-owner car insurance. If you don't own a car but occasionally drive borrowed or rented vehicles, non-owner car insurance might be perfect for you. This coverage provides liability protection when you're driving someone else's car, and it can also help you maintain continuous coverage, which keeps your rates lower when you do buy a car. Most insurance companies offer non-owner policies with the same liability limits as regular car insurance, typically ranging from state minimums up to $500,000 or more. The cost is usually much lower than regular car insurance, often $200 to $500 per year for good coverage. Non-owner insurance is also required in some situations, like when you need to file an SR-22 form after a serious driving violation, but you don't own a car. It can also provide coverage for rental cars, though you should check the specific terms since rental car coverage can be tricky. Here's an important note. Non-owner insurance is secondary coverage, meaning it only kicks in after the car owner's insurance is exhausted. So if you borrow a friend's car and cause an accident, their insurance pays first and your non-owner policy covers anything beyond their limits. SR-22 and FR-44 insurance. If you've been convicted of certain serious driving violations, like DUI, driving without insurance, or multiple traffic violations, you might be required to file an SR-22 or FR-44 form with your state. These aren't actually types of insurance, but rather certificates that prove you have the required minimum insurance coverage. Most insurance companies can file these forms for you, but they'll classify you as a high-risk driver, which means much higher premiums. SR-22 requirements typically last 3 to 5 years, during which time you must maintain continuous coverage. If your policy lapses for any reason, the insurance company is required to notify the state, and your license could be suspended. FR-44 forms are similar but require higher coverage limits and are used in fewer states. The cost to file these forms is usually $15 to $25, but the real cost comes from the high-risk insurance premiums, which can be 2 to 3 times higher than regular rates. Here's the key to managing SR-22 or FR-44 requirements. Shop around aggressively. Different insurance companies have very different approaches to high-risk drivers, and rates can vary by hundreds of dollars per year. Some companies specialize in high-risk coverage and may offer better rates than traditional insurers. Full glass coverage. While most comprehensive coverage includes glass damage, many insurance companies offer enhanced glass coverage that goes beyond the basics. Full glass coverage typically provides zero deductible for windshield replacement and repair, and some policies even cover side windows and sunroofs with no deductible. This coverage is especially valuable if you do a lot of highway driving where rock chips are common, or if you live in an area with severe weather that can damage glass. The cost is usually very reasonable, often just $30 to $60 per year. Some insurance companies also offer glass buyback programs where they'll waive your comprehensive deductible for glass claims if you haven't had any claims in a certain period. Others offer mobile glass replacement services that come to your home or workplace. Here's something most people don't know. Modern cars often have advanced driver assistance systems that require special calibration after windshield replacement. Make sure your glass coverage includes this calibration, as it can cost $200 to $500 extra and is essential for your safety systems to work properly. Diminished value coverage. Remember how we talked about diminished value earlier? Some insurance companies now offer specific coverage for this. Even after your car is perfectly repaired following an accident, it's worth less because it has an accident history. Diminished value coverage helps compensate you for this loss in value. This coverage is most valuable for newer or luxury vehicles, where the diminished value can be substantial. A $50,000 car might lose $5,000 to $10,000 in value after an accident, even with perfect repairs. Diminished value coverage typically pays 10 to 15% of the car's pre-accident value, up to policy limits. Not all insurance companies offer this coverage, and it's usually only available in certain states. The cost varies, but is typically $50 to $150 per year. Some companies include it automatically on newer vehicles, while others offer it as an optional add-on. Coverage stacking and limits. Here's something that can dramatically affect your coverage, but that most people never understand: how coverage limits work when you have multiple policies or vehicles. Coverage stacking allows you to combine the limits from multiple vehicles on your policy for certain types of coverage, particularly uninsured, underinsured motorist coverage. For example, if you have 2 cars on your policy, each with $100,000 in uninsured motorist coverage, stacking would give you $200,000 in total coverage if you're seriously injured in an accident. Some states require insurance companies to offer stacking, while others prohibit it, and some leave it up to the insurance company. Stacked coverage costs more than non-stacked coverage, but it can provide much better protection for families with multiple vehicles. The cost increase is usually 20 to 40% for the uninsured motorist portion of your policy. There's also something called inter-policy stacking, where you can stack coverage across different policies, like combining your auto policy with your spouse's separate auto policy. This is less common and not available in all states. Permissive use and named driver exclusions. Most auto insurance policies automatically cover anyone who drives your car with your permission, but there are important limitations and options you should know about. Permissive use coverage typically extends your liability and physical damage coverage to anyone you allow to drive your car, but the coverage might be reduced compared to when you're driving. However, insurance companies also offer named driver exclusions, which allow you to specifically exclude certain people from coverage. This is often used to exclude high-risk drivers in your household, like a teenager with multiple violations or a spouse with a DUI. By excluding them, you can keep your premiums lower, but if they drive your car and cause an accident, there's no coverage at all. Some insurance companies require named driver exclusions for certain high-risk household members, while others make it optional. The savings can be substantial, often $500 to $2,000 per year for excluding a high-risk driver. But the risk is enormous if that person drives your car. There's also something called household exclusions, where you can exclude all household members except those specifically listed on the policy. This is less common, but can be useful in certain situations. Multi-policy and multi-card discounts. One of the easiest ways to save money on car insurance is through bundling discounts, but there are more options than most people realize. Multi-card discounts apply when you insure multiple vehicles on the same policy, typically saving 10 to 25% on each additional vehicle. Multi-policy discounts apply when you bundle your auto insurance with other types of insurance from the same company, like homeowners, renters, or life insurance. These discounts can range from 5 to 25% depending on the company and the types of policies you bundle. But here's what most people don't know. The discounts often increase with the number of policies you bundle. You might get 10% for bundling auto and home insurance, but 15% for adding renter's insurance and 20% for adding life insurance. Some companies also offer loyalty discounts that increase over time as you stay with the company. There are also professional discounts for certain occupations. Teachers, engineers, military personnel, and others often qualify for additional savings. Good student discounts can save 10 to 15% for students with good grades, and some companies extend this to college students up to age 25. Anti-theft device discounts apply if your car has factory or aftermarket security systems. Defensive driving course discounts can save 5 to 10% and are often available online. Some companies even offer discounts for electric or hybrid vehicles. Deductibles and premium relationships. Understanding how deductibles affect your premiums is crucial for getting the best value from your insurance. Most people just pick a deductible without understanding the long-term financial impact. Here's the math that matters. Increasing your collision deductible from $250 to $1,000 typically saves $300 to $600 per year in premiums. If you never have an accident, you save that money every year. If you have one accident every 5 years, you still come out ahead. The break-even point is usually around one accident every 2 to 3 years depending on your specific situation. But here's what insurance companies don't tell you. You can often have different deductibles for collision and comprehensive coverage, since comprehensive claims, like theft or weather damage, are often less predictable than collision claims. Some people choose a lower comprehensive deductible and higher collision deductible. Some insurance companies also offer disappearing deductibles, where your deductible decreases by $50 to $100 each year. You don't have a claim, eventually reaching zero. Others offer accident forgiveness, where your first accident won't increase your rates, but this usually costs extra and has specific requirements. Policy limits. Here's something that confuses most people: how insurance policy limits actually work in real-world scenarios. When you see coverage listed as 100/300/100, that means $100,000 per person for bodily injury, $300,000 per accident for bodily injury, and $100,000 for property damage. But here's the critical part most people miss. These limits apply per accident, not per year. If you cause a serious accident that injures multiple people, you could easily exceed these limits. Let's say you cause an accident that injures 3 people, with medical bills of $150,000, $200,000, and $100,000. Your 100 to 300 to 100 policy would pay $100,000 to the first person, $100,000 to the second person, and $100,000 to the third person, leaving you personally responsible for $150,000. This is why many experts recommend much higher limits than state minimums. Coverage of $250 to $500 to $250, or even $500 to $500 to $500 often costs only $100 to $300 more per year than minimum coverage, but provides dramatically better protection. Some insurance companies also offer umbrella policies that provide an additional $1 to $5 million in liability coverage across all your policies for $200 to $500 per year. This is often the most cost-effective way to get high levels of protection. Claims process. Understanding how the claims process actually works can save you thousands of dollars and a lot of frustration. When you file a claim, the insurance company assigns an adjuster who determines fault, estimates damages, and authorizes repairs. But here's what they don't tell you. You have rights in this process that most people don't know about. You have the right to get your own repair estimates and to choose your own repair shop in most cases. Insurance companies often have preferred providers that they'll recommend, and while these shops might be convenient, they're not necessarily the best choice for your car. You also have the right to request a second opinion if you disagree with the adjuster's damage assessment. If your car is declared a total loss, you can challenge the valuation if you think it's too low. Most insurance companies use services like Kelley Blue Book or Edmunds to determine value, but these might not reflect the true market value of your specific car. Here's an insider tip. If your car is totaled and you disagree with the settlement amount, you can provide evidence of comparable vehicles for sale in your area to support a higher valuation. Many people don't know they can negotiate the settlement amount. For injury claims, you have the right to see your own doctors and to get a second opinion on medical treatment. The insurance company might recommend specific doctors or treatment facilities, but you're not required to use them. When to file a claim versus pay out of pocket. One of the most important decisions you'll make as a car owner is when to file an insurance claim versus paying for repairs yourself. This decision can have long-term financial implications that go far beyond the immediate repair costs. Most insurance companies track claims for 3 to 7 years, and multiple claims can significantly increase your premiums. A single at-fault accident claim might increase your rates by 20 to 40%, while multiple claims could double your premiums or even result in non-renewal. Here's the general rule. If the repair costs are less than 2 to 3 times your deductible, consider paying out of pocket. For example, if you have a $500 deductible and the repairs cost $1,200, you'd pay $500 through insurance, but might see your premiums increase by $300 to $500 per year for several years. However, there are exceptions to this rule. Always file a claim if there are injuries involved, if the other party might file a claim against you, or if there's any possibility of hidden damage that might show up later. Also, comprehensive claims, like theft, vandalism, or weather damage, typically don't increase your rates as much as collision claims. Some insurance companies offer accident forgiveness programs where your first at-fault accident won't increase your rates. These programs usually cost extra but can be worth it if you have a clean driving record. Are you more worried about protecting your car from damage or making sure you're covered if someone else hits you without insurance? Drop your thoughts in the comments below. And if you found this video helpful, don't forget to hit that like button and subscribe for more car tips and info. Also, if you want to dive deeper, check out this video we recommend next about types of car loans explained.